Welcome back to Stocks Academy. If you have watched my previous videos, you must have understood the basics of what are stocks. Now in this episode, we're diving into the bustling world of stock exchanges like the NSE and BSE and understanding the ins and outs of trading stocks and meeting the key players in the stock market. We'll also unravel the concepts of liquidity and volatility, crucial for anyone involved in the stock market. So let's start with the stock exchanges. You understood how issuing stocks is good for the businesses and buying stocks can be good or bad for the investors. Now the question arises, how and where to buy or sell stocks? Of course, there's a market, but it is not like the one that sells fruits or clothes. Instead, this is a market where stocks of multiple companies are bought and sold. In use, these markets are called stock exchanges. NSE and BSE are the two largest stock exchanges in India. In a stock exchange, companies can put up their shares for selling off through IPO. Buyer and sellers like you and me can go to buy or sell their shares not just from India but from all over the world. These platforms provide a structured environment for buying and selling stocks. For Tom, listing his pizza company on an exchange meant his business could attract investors globally, providing the funds needed to innovate and expand further. Now the next question is how the prices of stocks are derived. So if you remember in the last video, we learned that the price of a single share multiplied by the total number of shares gives the market value of that company. There is also a book value of a company which can be calculated by totaling all the assets of the company and subtracting the total liability of the company from that. So there is a book value and a market value of a company. Generally, the market value is much higher than the book value and it can be due to multiple reasons. Now, when a company gets listed on a stock exchange through IPO, they can decide at what price they want to get listed, but after it gets listed on the exchange, the price gets adjusted with a sudden increase or decrease. For the stocks that are already listed, the price majorly fluctuates due to demand and supply. It's just like the price of an onion. If nobody is buying onions and there are abundant onions in the market, the price of the onion will fall. Similarly, when there is a scarcity of onions and everyone wants to buy them, the price will increase. Let us understand the working of a stock market. Let's say there's a stock called ABC which is already listed on the stock exchange. Now there are many buyers in line to buy the stocks at different prices. Let's say someone wants to buy at 100, 98, 97.5, 95 and so on. Similarly, there are sellers who want to sell the stocks and obviously they would like to sell at a higher rate like 100, 101, 102.5, 104 and so on. So what happens in an exchange is all the buy and sell orders will be aligned and the rate at which the buyer and seller agree, then that trade will happen and the rate at which it happens becomes the last traded price. The price of a stock that we generally see on news or investment apps is actually the last traded price of that stock. If there are more buyers and less sellers, the buyer will have to place an order for a higher price. Hence, the price of the stock will increase. And similarly, if sellers are more, then they will have to sell at a lower price, making the price of the stock fall. However, there are multiple reasons why the number of buyers and sellers increase or decrease for a particular stock. We will be learning about them in my next videos. Now let's talk about the trading hours. Just like any other market, the stock market also has a time during which it is active. In India, the stock exchanges are active from 9:15 AM to 3:30 PM for 5 days a week. During these hours, anyone from individual investors to large institutional traders can buy or sell stocks. The market remains closed on some festivals and occasions. It is also important to understand the concept of liquidity to understand the working of a stock market. Liquidity refers to how easily stocks can be bought or sold in the market without affecting their prices. High liquidity in stocks means there are many buyers and sellers in the market for that stock, and you can quickly buy or sell shares at a stable price. If there are no buyers, then selling won't be possible, and there are no sellers, buying won't be possible. As stocks are always exchanged, they are not created every day. The only time when new shares get listed in the market is IPO and FPO. Understanding the role of stock exchanges, trading hours, as well as concepts like liquidity and volatility are all essential for navigating the stock market wisely. These elements help investors make informed decisions, responding adeptly to market conditions. In our next episode, we'll explore what drives stock prices and the impact of economic events on the market. Join us as we continue to decode the exciting world of stock market. Investments in securities market are subject to market risk. Read all the related documents carefully before investing.